Budget 2024 saw quite a few positive surprises for the debt market, especially on the fiscal deficit front. So, as debt mutual fund investors, what should your strategy be for the upcoming month? To discuss this, I have with me the head of fixed income for Kotak Mutual Fund, Abhishek Bisen. Abhishek, thanks so much for joining us. Let's start off first by talking about what happened in Budget 2024, right? We saw that 5.8 and 5.1% figure on the fiscal deficit front, which pleasantly surprised the street. The debt market, bonds rallied. We had the rupee rallying as well. Let's get your take on that.
Yeah, so let me just give you a snapshot what exactly it means. So, it's a structural change. If you look at from an economic perspective, reducing fiscal deficit, effectively cutting debt in the economy is a structural change, because if you increase debt, in a way you are fueling inflation. So cutting debt by a small number also means a lot from a long-term perspective. So if you have contained inflation from a medium to long-term perspective, effectively means rates are going to remain very well behaved and probably lower from the current levels. Therefore, we believe this is a very well commended number given the circumstances which we are living in, such kind of uncertainty. It is a very, very commendable number and credible number at the same time.
So, debt fuels inflation, and now that there's a structural change and more prudent fiscal deficit management, there will be hopefully a change in inflation too. Considering that, do you see yields then moving lower from here?
Since inflation is going to remain contained, yields are also going to remain much lower. So we typically say just to make you understand, today's 7 is better than earlier 8, because in real terms, this 7 is much higher in terms of real yields. Since inflation is going to remain contained, the 7 is going to give you much more real returns than earlier 8, when the inflation used to be much more higher.
Okay, I want to shift gears and talk about what happened at the US FOMC meet. I mean, it was overshadowed because of the budget, but we had the US Fed making it very clear that until inflation does not go to that 2% zone, they will not budge on rates. And we saw yields as well, staying above that 4% mark. What's your take on that?
So what Fed is actually doing is they're actually waiting for the thoughts to get converted into data, then probably act. Earlier, what used to happen, that they had a view or a sense on the economy that, okay, inflation is in line, this is how it is going to behave, and used to act in advance. This time, they know very well that probably now the trajectory is very well under control and it is going to decelerate. But they are wanting it to get more grip on the same and then act on rates. If you look at 2% long-term target on inflation, and today the 10-year treasury is close to 4%. So it's actually a 2% real yield, is almost double. Just look at from that perspective. So it is discounting in much more than what probably can get delivered from here on.
Your view on liquidity, because I remember the last time when we spoke, the conditions were very tight and RBI was really curtailing liquidity in the system. What's the condition like now?
Yeah. So liquidity is a handle which or instrument which RBI has used extremely diligently, I must say that, because using rates for everything to manage would have been probably punishing the entire village for a few culprits. Therefore, liquidity is one which they've been using it quite judiciously and maintained this overall balance in the economy by actively keeping the liquidity well behaved, contained, and we believe we are around neutral zone at this point in time. And probably till March it is likely to remain neutral to positive or slightly negative, if you can say that. And after March, when probably Fed situation also will be much more clearer and the fiscal will also be over, and then probably RBI may look to ease, because our inflation situation also will be much more clearer and the forward outlook also would be much, you will have a better grip at that point in time.
So, of late, we're seeing a lot of foreign institutional investors in interest in bonds. And this at the same time as they are selling Indian and Chinese equities, there's actually a nice inflow coming in of FIIs into the Indian bond market. What do you think are the reasons behind it?
Yeah, so see, it has what has preceded this overall action. At the end of the day, you are evaluating the economy as a whole. So if we look at from bond perspective, our economy, what is the ingredient for that? Growth and inflation. If you look at inflation is much lower than the growth number, real yields are positive, And the medium term outlook is also at the same time very benign on inflation, and growth is also coming. We are not decelerating significantly. Growth is also there, therefore currency is stable. So there is a good amount of interest from the FPIs. If you look at in relative terms in the entire region, we are one of the best yielding countries in terms of real yields. So which is getting reflected in the currency and at the end of the day in bonds. So which is probably forced them to include India into the index, and many much more such news are going to emerge over a period of time, and which is going to benefit the economy. This is again, as I said, is a structural change, and it is going to have a very long-term impact on the funding structure, on the rate structure of the Indian borrowers, government and corporate at the same time.
All right, so we're clearly in the midst of changing a landscape from a debt investor point of view. Considering that, what would be your advice as to the strategy that debt fund holders should deploy?
See, interest rates and returns are slightly inverse if you know that relationship. If rates go down, your returns are actually going to go up. So therefore, we have been recommending from some time now that you increase your duration of your portfolio as much as you can, depending on what your needs are. But assuming you have a reasonable investment horizon and you have reasonable risk taking capability or in terms of volatility, you should increase as much as you can at this point in time, because we are in a structural change. Probably these numbers will be not seen again for a very long period of time. So whatever is going by is going by. Probably it will take long term to come back. What we see in terms of oscillation, 7 goes to 8, 8 goes to 7, and probably 6 then again comes back. So since these are structural changes, therefore probably the probability of this coming back again is getting lower and lower.
Thank you so much for joining us, Abhishek.
Welcome.
Increase the duration of your portfolio as we are in the midst of a changing landscape for the debt market in India. That is the view coming in from Abhishek Bisen. Thank you so much for watching. Stay tuned to Kotak Mutual Fund's YouTube channel. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.